Hello, Todd Goldman here. Welcome to the second episode of the video series, Finding the Right Advisor for You and Your Wealth. If you missed the first episode of the series, I do encourage you to go check it out. In it, I cover the basic challenges facing anyone shopping for financial advice and considering hiring a professional for guidance. And one of the main issues to overcome, and the one we'll be addressing in this video, is the confusing nature of the financial service industry itself. Over the decades, a massive industry has evolved around banking, investing, and the capital markets. But to the average consumer, it's not at all clear of who is who and what's what and how it all fits together. In fact, if you were to ask someone the difference between Goldman Sachs and Northern Trust, or perhaps Capital Group and a privately owned investment firm like the one I work for, I'm quite sure that they couldn't tell you the difference. But it is, in fact, these differences that impact how advisors are compensated, the regulatory standards that they're held to, and the suite of services that they're able to offer you. So, before you start going on dates with prospective advisors, it's helpful to understand a little bit about the world they live in, since you'll be living there too. With that said, why don't we kick things off by reviewing once again the definition of an advisor, slightly expanded. So, an advisor is someone getting paid by you, directly or indirectly, to provide advice or services regarding your money. And of course, by money, we define that as anything on your balance sheet. So, for those of you that perhaps don't have a business background or never seen a balance sheet before, in essence, a balance sheet is just a quick two-column accounting of everything you own on the left-hand side and all of your debts or what is owed on the right-hand side. So an advisor can, in essence, give you counsel on any one of these line items or a combination thereof. Depending on your situation, one of these areas might need more attention than the other at this point in time or in the long run. But in essence, you've got on the asset side, you've got your cash and bank accounts. Those are obviously handled by bankers. Your taxable investment portfolio, that's any investments that you have that are outside of standard retirement accounts or pensions or things of that nature, as well as your retirement accounts, which include 401ks, IRAs, and pensions. Those two categories are largely covered by the large universe of what's broadly thought of as investment advisors, stockbrokers, folks in that nature, in that world. You also have your insurance products, which some insurance products can actually be assets and others are liabilities. It kind of depends on the nature of what the policy is and what it's doing for you. Real estate, stock options, things of that nature, also assets. Generally, it can also be, you can get some guidance from those from traditional financial advisors. Pretty much anything else you can own is an asset. On the liability side, your mortgages, home and commercial loans, credit cards, lines of credits, business loans, all of those things are generally handled by banks. So similar to your deposit accounts, a banker is going to help you with the lending component. And that is a big part of most folks' day-to-day financial matters. Also, as I mentioned, there's the insurance products. And truthfully, taxes, not that they're a liability necessarily, but you have to pay them every year. So obviously, tax advice is the one component that almost anybody looks for once your level of wealth reaches a certain level of complexity. So what we have here is, once again, the list of job titles, examples of job titles that you'll typically encounter as you're out in the world investigating who might be able to provide guidance for you. And I've color-coded this version of it just to kind of give you a sense of kind of who does similar type of work. I've got it parsed on the left-hand side, of course, the long-term relationships, and then on the right-hand, the short-term. Again, as covered in the original episode, the first episode of the series, you'll want to know exactly what type of relationship you're looking for with the advisor. Is this something that's going to go on for many years, ideally, or is this more of a transactional type relationship? Either way, again, these are some job titles. When you meet someone, maybe you can kind of this will help you fit them into the right category. So the green ones are your banking type relationships. Your private bankers, your mortgage brokers, these are the folks that are really helping you with as much the debt component as anything else. The blue group, which is a lot of names in the group, the blue grouping there, those are, again, the broad, I'm going to use the term investment advisor, stockbroker, wealth advisor. They're all somewhat interchangeable, depends on the firm, what term they use. But they're the ones that are advising on the taxable part of the portfolio, as well as oftentimes the retirement accounts, if you have control of those retirement accounts. Insurance brokers, I've got those in purple. And then the red category, business managers and multifamily officers are kind of like investment advisors on steroids, and I'll kind of get into the differences between those in subsequent slides, but I did want to parse them because they're a little bit different. The yellow trust officer rather, that is a very specific role or profession that you would engage if you are a beneficiary of a trust or a grantor of a trust. An irrevocable trust, that is, that you are no longer going to be trustee of, or you never had the opportunity to be the trustee on. Under those circumstances, you will have a institutional trustee, a large trust company, or something along those lines, or bank, and there'll be someone who's assigned to act as trust officer. If that's all very confusing, that's fine. It's probably not applicable to you, but just something to keep in mind that there is a scenario whereby your advisor is, in fact, the trust officer. I included in here, of course, the CPA. The CPA is providing all the good guidance on tax. The more complicated your financial life, the more you need the CPA. Now, it's worthwhile to cover what it is, in essence, you are basically buying when you hire an advisor. Now, I like these 4 items. I think it kind of clarifies it pretty well. So I'll run through them quickly and explain them, and that'll give a framework or context to the rest of the industry as we look and see what different types of companies do and what type of services they provide. In essence, when you are buying someone, you've got implementation, which I describe as the actual buying and selling of and holding of securities, stocks, bonds, mutual funds, any number of limited partnerships, any number of entities. It's also about actually getting the loans and buying insurance. That's the actual doing or getting of the thing. The next component is advice. And advice is guidance on all the things that I just listed. Also, retirement, tax, and estate planning, other big components of managing wealth. The third component is access. And this is just generally the introduction to and the ability to buy restricted investment funds, private investments, and oftentimes real estate. That comes in a number of forms. Some investment companies or advisory firms have proprietary strategies that you can only access if you are a client of that firm. Otherwise, there's a number of non-publicly traded investment opportunities out there, typically in the form of a limited partnership that you can invest in. They're illiquid, meaning you can't readily sell them. You have to wait for them to mature or work themselves out. There's advantages to investing in this type of investment vehicle, and generally the only way to gain access to them is to have someone that knows the general partners or the person running the strategy. Oftentimes, the best and easiest way for the average person to gain access to those is to work with a firm that is sourcing these deals on their own. This is an area of expertise that my firm has, so I'm very familiar with this one. The last component of service that you're buying with the advisor is concierge services. So these are basically when your life gets to that point where you've got sufficient wealth and limited time that you just want to offload a lot of the day-to-day management of things that are related to not just your wealth, but your life in general. So this can entail at its core bookkeeping, tax prep, property management, staff hiring, payroll, vehicle management, etc. This is a need that generally applies to a rather small percentage of the population, but if you happen to fall into this category, it's certainly an important benefit to you and one worth investigating. Now, I'm going to start defining the different types of firms, and this again shall give some guidance. But at its core, there are 5, 6 different large group categories that I like to to reference. First, you've got your discount brokers, then your robo-advisors, fee-only financial planners, the full-service firm category, that's a large group, which entails a number of different types of companies, and then the multifamily office and business management firms. That's, again, I'll get into what those are. And then the last is accounting and legal firms. I'm not going to spend a lot of time on the legal and accounting firm industry because honestly, it's much easier to understand than any of the financial service, any of the other companies in the financial service arena. They are typically partnerships, a group of lawyers got together, they form a partnership, or tax professionals get together and form a tax firm. So that's pretty straightforward, easy to find. The full service firms, let me go back and explain those a little bit more. So in this category, there are brokerage firms, registered investment advisors, sometimes called RIAs, insurance companies, asset management firms, investment banks, commercial banks, and trust companies. A lot of different types of businesses, and they have fairly distinct differences in the way they operate. So we'll spend a little bit more time in this video, and then in 2 or 3 subsequent videos, we're going to be looking at them in great depth to understand what the benefits are to each of them. So with that in mind, the way I like to describe it, again, going back to the original 4 components of what it is you're buying, is to look at the core firm types and say, well, what is it that I'm going to get with each of these types of companies? Or the other way to look at it is like, if all I really need is implementation, who should I be talking to? Or if I need implementation and advice, who should I be talking to, etc. So looking at this grid, it's a spectrum of service. So on the left-hand side, we start with the implementation only. The firms that only really help you just do the work are going to be your discount brokers, your robo-advisors. So discount brokers are your very low-cost, do-it-yourself firms. Like, these are just a few names, not all. It's not an exhaustive list, but you've got E-Trade, Scottrade, Fidelity, TD Ameritrade, Robinhood, companies like that. They started coming into existence around 1992, just to give you a little historical context. Now, the robo-advisors are an evolution of those discount brokers. And what they do is not just give you a platform to trade on, they're also going to run a portfolio for you. So that you don't have to decide what individual stock, bond, or mutual fund to own. They are going to help you by saying, well, what's your goal? We can create an asset allocation that will help you achieve that goal, and will manage that for you. So you can just put the money in, and then they'll do the buys and trades as needed along the way. So those are companies like Wealthfront, Betterment, SoFi, and they came into existence around 2008. Now, if all you need is advice, then the best arena or service provider to go to for that is just the fee-only financial planners. So there's not a lot of brands in this arena. There may be a few boutique firms in your market or wherever you live, but generally speaking, these are standalone financial planners that will charge just an hourly rate or maybe a flat fee to prepare to do a financial plan for you, which is just a deliverable. They give you the report, and then it's up to you to act on it or implement it down the road. But either way, you're really just paying for their advice, straightforward. Now, if you want implementation and advice, that's when you're typically going to turn to the full service firms. Some of those also provide access. As I mentioned, my firm provides all 3: implementation, advice, and access, but not all of them do. So just we're going to expand upon that category a lot more, but by its very definition, a full service firm is one that's striving to provide the full spectrum. Now, the multifamily office and business management, again, that's when you need everything: the implementation, the advice, the access, and the concierge services. Maximum complexity, maximum cost, right? Because you get what you pay for. If you're getting a lot, you're going to have to pay for it. So, but again, if you're in a situation where you would really benefit from that, it's money well spent. So drilling down a little bit further on the full service firms. And again, as I mentioned earlier, this is kind of the lion's share of most of the companies that are in the marketplace kind of fall into this category. And we can evaluate these companies on a number of different criteria. And actually, I will in episode 5. But to start with, this, I'm going to look at just the nature of the relationship between you and the advisor, or you and the firm. If you recall from the first video, I mentioned that when you hire an advisor, it's really not a two-party relationship. It's a three-party relationship. It's you with the human advisor, and then the human advisor works for a firm. And you can determine whether you're going to have a closer relationship to the human being or to the entity, the firm that's providing services and features to you. So typically, different business models are set up in different ways, such that sometimes the advisor has an ownership stake, or the platform is really secondary, and other times the advisor is really more of an employee of the investment firm. So just something to keep in mind as we're looking at the different firms. But we'll start with, if you really want to be tight with the advisor, then you're talking to brokerage firms. Now, these are your traditional, they used to be called wirehouses. They're like the big old stockbroker firms of ages past. Just a few names. There are a lot of them. I'll give you a few. Edward Jones, UBS, Ameriprise, Merrill Lynch, Morgan Stanley, LPL, Raymond James, Wells Fargo Advisors. These are some big companies. They have a lot of reach. They've got a lot of advisors that work on these platforms. And you oftentimes will meet a financial advisor who is at one of these companies. You should know, keep in mind, that is someone that is working with a brokerage firm. Odds are you're going to work with that person because you like that person. It's not as much about what that platform has to offer you. Registered investment advisors. These are companies that are independently owned. This is the type of firm I work for. Independently owned, where the advisors are oftentimes the owners. So they have the potential to be smaller or more boutique in nature. They do come in a range of sizes, and there has been some consolidation in the space. So there's a few companies that you can run into these days that are pretty sizable. But for the most part, if you meet an advisor who's at an RIA, odds are that person will likely stay at that firm, in large part because they're probably a partner or on a partner track. Now, insurance companies are the next entity in this world. Names in this area, of course, you've probably heard of the big insurance companies, but there is Lincoln Financial, Northwestern Mutual, Transamerica, MetLife, big insurance companies. Now, the primary focus is obviously the sale of insurance, which is an important part of your financial planning. But what insurance companies often do is they actually have a broker-dealer or brokerage arm attached to the business entity. So if you meet somebody initially for purposes of securing insurance, you can then also work with that person to help manage your portfolio as you grow it. Working our way to the right, farther down the spectrum, you'll see that the next in line is asset management firms. Now, these are companies that, in essence, got their origin under the strategy of like, hey, we can build a better portfolio. Companies in this category are Capital Group, AllianceBernstein, BNY Mellon, just a few of them. And these are folks that really, they said, we built a better mousetrap, so come work with us. We'll let you use our mousetrap. Now, what a lot of these companies started as just investment firms, and then they added on the advice or the actual brokerage, not a broker, I'm sorry. They've added on advisory services as well. So they have one arm that actually manages mutual funds and provides strategy on one hand, and then on the other hand, they're actually working one-on-one with clients as well. Next on the list is going to be investment banks. These are the big names that you've probably heard about. They're in the news all the time. You've got your Goldman Sachs, JP Morgan, Credit Suisse, Citigroup. They're big animals, big entities, big market makers. They provide a lot of extra services as well. They've got core banking. They do mergers and acquisitions. If you have a business you're trying to sell, you can work with them perhaps. There's a lot that goes into them. They tend to be a little bit more upstream as far as the size of client they want to work with. I'll get into that in a minute. But for the most part, if you're working with them, you're probably working with them because you like the entity itself. You may feel a great deal of affinity with your advisor there or the advisory team, but keep in mind that they are employees. If they were to leave, you may be more inclined to stay with the firm. Next in line would be your commercial and retail banks. These are the folks, everyone's got a bank, right? If you've got a checking account, they are leading with lending. That's their highest and first line of revenue. So the advice piece is kind of an add-on. Some of them do a very good job of it, but it tends to be a little bit less complex solution. That's my personal opinion. I could be wrong. So all the bankers out there, take no offense, I hope. But oftentimes, if you are working with one of these entities and the person you're working with, the advisor was to leave, you would likely stay because all of your loans are with the bank. And then on the farthest end of the spectrum is going to be your trust companies. And this is largely because if you're working with a trust company, more often than not, it's because you need the services of the trust officer. It's perhaps you have an irrevocable trust in place, and you're just not going to leave for those reasons. There's a few exceptions there. Some trust companies do take on ordinary clients that don't need the trust services. Under those circumstances, probably the relationship's a little bit more like an investment bank or an asset management firm. But that should give you a little bit of perspective on just the nature of the different types of full service firms, at least as how it relates to the relationship between you and the human advisor or you and the company itself. Now, it's worth addressing this one point, which is there is a lot of overlap of firm types and the services that they provide. So some examples of what this might look like is you can have a CPA firm that has an RIA attached. So you're going there primarily to get your taxes done, but they may also have the capabilities of managing your portfolio or helping you run your portfolio. On the flip side, sometimes there's a registered investment advisor that would have an enrolled agent on staff, which is someone who's authorized by the IRS to prepare tax returns. Not quite the same thing as a CPA, but they can still do your taxes for you. Law firms, this is, I believe, more common. I'm in the Los Angeles market. It's not as common here, but on the East Coast, I know there are a lot of law firms that have trust departments embedded in them. So if you're seeking out legal advice, you can oftentimes use their trust department. And then what you start to see now is there's a lot of discount brokers that also have a robo-advisor, and they also have institutional services with a 401k services as well. So a company like Schwab or Fidelity, they've kind of got a lot of everything all stacked in there. And a couple things to keep in mind is overlap of services can be a convenience. So there's a benefit to that. So if a firm offers that, that's great. Just keep in mind that you want to know how dedicated the company is to the secondary or perhaps tertiary line of business. Because obviously they had one core component to how they started the company. They added on more services. Are they able to fulfill those at least to your the level of your need? To my other point that I had made earlier a second ago, vertical integration and ownership is a real thing in the industry right now. So the example that I've listed out here is Bank of America is a commercial bank, but they own U.S. Trust, which is a trust company, and they also own Merrill Lynch, full brokerage for the ultra high net worth group, which is probably more like a multifamily office arena. And they also have a high net worth group, which is probably your kind of bread and butter full service firm. They also have a robo-advisor called Merrill Guided Investing, and Merrill Edge is their discount broker. So as you can see, they kind of cover the entire spectrum of different types of companies all under one umbrella. So if you're talking to someone who's at Merrill Lynch, it's probably a good idea to kind of get some clarity around, well, what is it you do? What part of the universe, of their universe, do you work in? And of course, JP Morgan, Wells Fargo, Citigroup are structured similarly. They have kind of the full spectrum as well. So just a good question to ask as you're running into folks out in the world. Now, I want to talk a little bit about the size of your account and how it's going to influence the universe of firms and who you could potentially work with. The reality is, working in the financial services arena, it's highly regulated by the US government. There's a lot of costs associated with doing it, a lot of technological costs, and so forth. So, depending on the business, they can't always make enough money off of clients of a certain size in order to be profitable. So, different types of companies, even different companies within a type, will focus on different parts of the market. So, you as a consumer coming in with a portfolio of a certain size, it's helpful to know, oh, I've got $250,000. Who can I talk to? Who should I just not even waste picking up the phone and calling? This hopefully can give you a little bit of guidance. It's not hard and fast. It is dependent upon what market you're in. Again, I'm in Los Angeles, so it's kind of a high-end market. If you were in the middle of the country, some of these numbers might shift lower. Rent is just cheaper in Tulsa than it is in LA or New York. So these are all factors just to keep in mind. So on the very low end, if you're just getting started, you can always use discount brokers, robo-advisors, and generally insurance companies. They have a little more latitude as far as bringing on clients with small accounts. Probably not going to get a lot of service at that level, but that's okay. You're just getting started. That's kind of the whole point. Commercial banks and retail banks oftentimes will have slightly lower minimum accounts as well. So if you're, I don't know, ballpark $100,000 range, you should be able to get some guidance from those platforms. When you get to about $200,000, $250,000 to and up, that's when you can start having conversations with the full service brokers and the RIAs. Again, those two professions tend to have a little bit more control over the size of the market that they're working with. Again, they're kind of like entrepreneurs. They've got their own business at play there. So typically in that arena, you can get some flexibility. So if you're at $250,000 in Los Angeles, you just want to make sure you're talking to someone that has minimums that low. My firm, by way of example, when it started, it's a 30-year-old firm. When it started out, it took clients of all sizes, but now we've grown to the point where our minimum investment size is $2 million. So just to kind of give you a sense of how things change. When you get to the asset management firms and trust companies, again, those typically are looking for clients in the $2 million and up ballpark range. Some of them even higher. Investment banks, at least the one in the higher markets, generally speaking, they want at least $10 million. I've heard of some teams that will only talk to you if you have $25 million in the portfolio. And then at the far end of the spectrum, multifamily offices and business managers, they aren't necessarily have a minimum size, but again, the nature of the fees that you're paying for all the concierge services and everything that goes along with it, typically that makes the most sense when your net worth, your portfolio is approaching $50 million, maybe as low as 20, but and that again is very flexible. It just kind of depends on what you're comfortable paying for at that point. Fee-only planners, they will doesn't matter how much money you have, you can always go work with a fee-only financial planner. Again, because they're charging by the hour or as a flat fee for the entire package. So you're just paying for what you're getting. Now, one thing to keep in mind, the numbers I've been giving you are generally minimum amounts. So what you can decide is, just by way of an example, like fingers crossed, everybody here that's watching this has $5 million in their portfolio. Okay, you have some options as far as where you want to go. You could go, I call downstream or upstream. Do you want to be a big fish in a small pond or a small fish in a big pond? Do you anticipate growing as a fish? Do you want to, or do you think you're in the point where you'll be drawing from your portfolio and maybe moving down a little bit? That might shift how you position yourself within a firm or the type of firm you'd want to target, just based on your own preferences. If you were a $5 million client and you went to work with someone whose minimum is $1 million, you're going to be a very big fish for them, probably. If you were to be a $1.5 million client and you went to a $2 million firm, even if they gave you an exception and let you work with them, you're not going to be one of their biggest clients at that point. Now, circumstances change. Maybe you're going to grow your wealth significantly, in which case it might make good sense for them from a business perspective to take you on as a client and still provide good service. But those are factors that have to go into the calculus for the business owner or for the financial service firm itself. While we're talking about the size of your assets and who you can work with, it is helpful to understand how fees and payment work in this industry. So just broadly speaking, you'll be charged a number of different ways, either per transaction, basically trading fees. You might be charged a wrap fee or a percentage of the assets under management, oftentimes called AUM. And that number is around 1%, give or take. Or there's going to be a sales commission built into the price of the product itself. Now, that shows up in insurance. If you're buying an insurance policy, if you are buying bonds, oftentimes the price, there's no transaction fee on it, but the sales commission is built into the price that you're paying. So that's how you get charged into the firm itself or the entity. And then the advisors get paid out in different ways as well. So they can either make a commission on new business, salary plus bonus, or a revenue split with the company. So knowing how the advisor is compensated is helpful to you to understand where their motivations lie. In a perfect world, everyone acts in the best interest of their client, but let's not be Pollyanna. Money is a factor for a lot of folks. So you want to understand where they're getting their revenue from so that you can evaluate the advice that they're giving you. Plain and simple. Couple of points just keep in mind. Cost is only an issue in the absence of value. So also some people say you get what you pay for, things of that nature. If things seem expensive, just make sure you're getting value from what you're paying for. And the way you define value is going to be different than the way I define value or someone else sitting next to you on a bus or the train is going to define value. So what we'll talk about a little bit in subsequent videos is really identifying, okay, what is it that you need and what is it you really want? What is it you value from the relationship? And just make sure that whatever the cost you're paying, you're getting those things in return. And the other thing is, of course, nothing is free. So if anyone's telling you that they're providing something for free, all it means is they've hidden the costs somewhere, and it's probably worth asking a few questions. Okay, now I'm going to just take a minute to go over a very brief, this is my own personal take, history of the industry and how it affects the culture of the firms that remain in business today. The idea of going through the history is so that perhaps if you understand the culture of the firms a little bit, you might help you understand the individuals that work there. Just because the people that succeed at a particular company usually have a shared sense of values and culture. And I do believe the culture of a firm is embedded in the history of the firm and when it was founded and what was most successful at that time. So if you go back to the history of the stockbroker industry, all the wirehouses back in the day, it was a lot of very aggressive selling. So the advisors would call up someone and say, hey, Jim, it's Bob. I think you should buy GE, sell Kodak. And he would say, okay, that sounds good. Boom. They make the trade. He makes the commission. It was as I said, very personality driven, very sales driven. So companies that the oldest wirehouse firms, very much sales entities, people that work there and succeed there, good salesmen. Then what happened around 1940 was the advent of basically investment companies. And that was a turning point where the companies then said, hey, you know what, rather than letting the individuals decide what to buy based on the advice of a salesperson, how about if we run the portfolios, we'll decide what stocks to own and what bonds to own, and we'll put them into these entities. So the portfolio became the focus, and it was the folks that could make a better mousetrap were the ones that succeeded. So the really wonky, really quantitative driven, really smart folks in that world were the ones that succeeded. And that worked for a very long time. Then, again, with the advent of the internet in the 90s, or the proliferation of the internet in the 90s, what came to have the advantage was technology. If you had a trading platform that was really efficient, low cost, then people could just go directly there. They could bypass the other service providers and just make their own decisions, buy the funds that they wanted, buy the stocks and bonds that they wanted, so forth. And that worked for a very long time. But what it resulted in was the actual implementation component of the services became like water. It's a commodity, right? It didn't have any distinctive qualities. You could trade a stock as easily on E-Trade as Scottrade. So at that point, what evolved was the world of the benefit of advice. That's when folks realized, like, well, okay, yeah, everyone can still do their own trades, but do they have enough knowledge, or do they have the time to do the research to understand the implications of owning X, Y, and Z versus ABC? Or do they know the importance and role of insurance in their portfolio, or retirement planning, or estate planning, any of these things? So at that point, that's when advice started getting layered in on top of all the other services, which frankly had become a little bit of a commodity. So again, if you look at any firm and the history of the firm, you'll know when it was founded, and you can kind of get a sense of where they have a sense of where their values are and what they think it takes to succeed. Once you know that, then you're going to get some insight into the personality of the advisor, because if that advisor's been with that firm for any length of time, they fit that culture very well. So again, hopefully that'll be helpful as you kind of look at the different options out there. That's it for this episode. Thank you for tuning in. If you found it helpful, I do encourage you to like and subscribe. Tell your friends all about it, however you'd like to do that. You can do it analog, actually call them. If you are looking for more information, additional content, or copies of this presentation, you can find them on the website, www.rightadvisor.com. That's RIGHT-advisor with an OR at the end, .com. And if you need any help with your search, or if you have a specific question that I didn't cover in this video but you'd like an answer to, feel free to email me. I'm todd@rightadvisor.com. And I hope you'll join me for the next episode in the series. We're going to be covering step 1 in the process that I outlined in the episode number 1. But step 1 is, what are you buying and do you need it? So I look forward to seeing you then. Until then, farewell and good fortune.